If a management team makes very poor allocation choices, it can destroy value. If it makes good allocation choices, it can generate value.
Hey, Matt, what does capital allocation mean?
Yeah, so when a company takes in more cash than it spends, we call that discretionary cash flow. So that discretionary cash flow, we want to know how management allocates that cash flow. And that's what we mean by capital allocation. And there's several things that a company can do. It really has five options. One is it can buy back shares, it can pay dividends, and both share buybacks and dividends are ways of returning money to shareholders. It can pay down debt, so it can reduce its debt load, and then it can acquire other businesses or it can grow organically. So, for example, maybe you have a fast food chain and it opens up other stores. We call that organic growth as opposed to acquiring other businesses. But those five uses very heavily influence the value of the company but it depends very heavily on those capital allocation choices that management is making.